Hello guys, it's James from FXax here, and today we have part 1 of a 2-part series for you that you are not going to want to miss. Watch this one the whole way through and catch us for part 2 as we cover 6 game changers to get you well on your way to becoming a profitable Forex trader. If you are new to the channel, welcome. We provide transparent, informative Forex content without the BS. Before we begin, a disclaimer for you. Forex trading carries a high level of risk to your capital, and you should only trade with money you can afford to lose. And remember, the content we produce is for educational purposes only. We have also marked timestamps on the video to help you guys navigate to different parts of the content if you so please. However, we do advise you to watch the entirety of the video. If you did enjoy watching, please do like, comment and subscribe. It will help us with those YouTube algorithms. There are countless articles and entire books written on the best tips and tricks on how to become profitable, or more profitable, in the Forex markets. We've done the research, read the articles, flipped through the books to bring you guys what we feel are the top 6 game-changing tips that every trader needs to know if they are to be profitable in the Forex markets. These trading tips are relevant for any asset you are trading, from Forex to crypto, precious metals, oil, and even commodity futures, such as corn or soybeans. Yes, you can actually trade corn and soybeans. Have realistic expectations. Don't fall for the hype, the Lambos, and trading from the beach. The web is rife with folk who show themselves trading while sitting on the hood of their Lamborghini or kicking back at the beach, sipping pina coladas while trading on nothing but their phone. Let me guess. I'll bet these same people are trying to sell you a course or trading signals or their secret method, right? The truth of it is, if you want trading to supplement your full-time income, you need to treat it as a full-time job and take it seriously. Traders often have a home office with multiple screens and can spend long hours in front of those screens to earn their income. Trading can be a very lucrative and fulfilling career, as you have the freedom to work your own hours as much or as little as you want, with the potential to greatly increase your income. But that probably isn't going to happen from your tiny phone screen while drunk off cocktails getting sunburned on a beach. The people highlighting these lifestyles are trying to sell an unrealistic dream or have achieved very unsustainable, lucky trading results by not using proper risk management. For every one YouTuber you see flaunting these types of results, there are thousands of people who have likely lost it all by over-leveraging and taking on excess risk. This would be like if 1,000 people walked into a casino. The first person puts $1,000 on a red 33 at the roulette wheel, gets lucky, wins big, then tells the other 999 people that they can do it too, and says he can show them how, but the chances and statistics show that likely none of them will. The great thing about trading is that there is always a market to be traded, so you are essentially in control of your own income as you can work as much as you want. If you want to put in 12 hours a day and trade all day, every day, you can. If you want to casually place a trade on your lunch break at work or during the commercial break of your favorite TV show, you can. A career as a trader is only limited by the person doing the trading, which is what makes this one of the most sought after careers in the world today. Nearly unlimited earning potential and the freedom to be their own boss, not dragging themselves to the office every day. Who doesn't want that? But it isn't going to happen overnight, and it isn't as easy as many make it out to be. Proper risk management is arguably the most important factor when looking at what separates a long-term successful career trader versus someone who consistently loses money and ends up quitting trading altogether. This goes hand in hand with proper trading psychology and managing emotions. The most successful traders are the ones who don't place trades based on emotions and feelings. They have already determined their trading plan, they know their entry and exit points, and they know exactly why they are placing the trade before they place it. They don't just wing it, place a trade, and hope for the best. Managing open trades and understanding your risk to reward ratios is key to long-term success. Trading is a percentages game. You're going to win some, you're going to lose some. That is just the name of the game. Proper risk management ensures that when you win more than when you lose. And that is balanced with the percentage of trades you win. Now, strap yourselves in for this. It's time for some numbers. Weird dancing meme to the right and key Forex information to the left. I have used strategies with only a 25% win rate. And you might think that sounds horrible. Why would I use a strategy that only wins 25% of the time? Well, because the risk to reward ratio on those trades were 5-1. I have also used strategies with a risk to reward ratio that is 1.3-1, that win approximately 50% of the time. So even though they only hit a take profit of 0.3 over what I am risking, the high win rate keeps me profitable. You need to know your numbers to make sure that your money management is going to keep you profitable. I remember when I was first starting out and someone explained to me that you can make money flipping a coin with proper risk management, so as Forex traders, we should definitely be able to do better than the odds of flipping a coin, with all that training and trading tools at our disposal. And here at FXX, that is exactly what we are going to show you how to do. You may have heard the terms scalping and swing trading thrown around. Well, what exactly do these mean and how do you know which one you are? Well, it really comes down to your personality. How much stress you want to be involved in your trading, how much time in front of a screen you can allocate, and what returns you are looking for. Only you can determine this for yourself. Let's start with scalping, and what sort of traders scalpers are. Scalping is often considered the hardest and most stressful style of trading. These traders are watching charts all day, glued to the screen, multiple charts open, and entering and exiting trades quickly. Scalping involves placing multiple trades a day, even multiple trades per hour. This is an incredibly hard skill to learn, and even harder to master. But for the traders who master this skill, it can be the most lucrative. This is also the style where many traders lose the most, as they can get very emotional and revenge trade, as this style of trading can involve multiple losses in a row. Many new traders lose money scalping as they are attracted to the fast-paced action and earning potential that successful scalping can provide. This style of trading involves multiple small wins and losses, often a few cents or dollars per trade. These are not the home run, massive winning trades you often hear about. These traders attempt to take full advantage of small market fluctuations during the day to make up cents and dollars to make a profit at the end of the day. Scalpers find themselves at the mercy of news events more so than other traders, as they need to have a finger on the pulse of what is happening in the world to ensure news events won't throw off their trades, or they may choose to trade in the direction of news events when they happen. In order to be a scalper, you need to have nerves of steel, quick reflexes, keep one eye on the news, and use a broker with very small spreads. Next, we will cover day traders, probably the most popular style of trading as it is not as intense as scalping, but often more profitable and hands-on than swing trading. This is a style of trading that most traders use to replace their income and make a full-time job out of trading the Forex markets. This style of trading is a little slower paced than scalping. Here, instead of trying to take advantage of the smallest market fluctuations, as is done with scalping, traders are looking for more solid setups, waiting for everything to align on the charts while trying to gauge the intraday direction of the market. This style of trading is often done only during times of the day with the most trading volume, often at session open and closing times. Many day traders will set alerts at certain price points so they can take time away from the screens and go walk the dog, run some errands, or catch up on their favourite FXX trading videos, while waiting for volume to pick up, usually during London or New York sessions opening and closing times, depending on where they live. Day traders also need to keep an eye on the economic news, as news events can throw off trade setups and cause price to completely smash through areas of support or resistance identified by the trader. Day traders typically look to place 1 to 5 trades per day based on setups and criteria being met and how the market is acting that day. And finally, swing trading. For the I ain't got no time for that type. There is no rule that says you only need to stick to one style. Many day traders and scalpers also swing trade, as this is the most hands-off, set and forget type style. They can place a trade and not look at it for days or even weeks while continuing to day trade or scalp. This kind of trading involves a trader carrying out a longer-term overall outlook of the currency they are trading. They are less concerned about daily news events, the daily direction of the market, as they are more focused on how is this currency going to look next week, next month, or even quarter. If a trader believes one currency has a stronger economic outlook for the year than another country, they can place trades based on their bias and leave them open for weeks or months, and not need to micromanage these positions daily. Generally speaking, swing traders place the fewest trades, and normally do not have the same earning potential as day traders or scalpers due to the fewer trades being placed. Swing traders are often the ones who are shooting for the big home run plays, which can play out in their favour, though it should be also noted that they are betting bigger on the outcome of that one trade. So if the trade does not go in their favour, it can be a little more devastating, as that may have been the only trade they have opened for days. Anyway, guys, that brings us to the end of this video for part 1 of this part 2 series. Thank you for watching, and stay tuned for part 2 as we cover 3 more game-changing topics that you won't want to miss. I hope you have found this video useful, and make sure you continue to be wary in this industry. Please visit www.fxax.com and join our completely free Telegram channel. All socials are in the description below. Thanks for watching the video. We hope it's been useful. Stay tuned for more content.